Hello, everyone. Welcome to Peak Market Watch. Welcome, John. Happy to have you on.
Hey, good afternoon, Anton. Good to see you.
Yeah, same here. So my name is Anton Madley with Peak Financing, and my colleague John. And as everyone knows, we had the Fed meeting 2 days ago, and we always want to wait for maybe a day or two to see what the reaction of the markets is before we start commenting on it. Now we have seen where the market has been settling and what their view is going forward. So we will share with you the forward curve a little bit later in the call. But let's first look at the Fed's statement as well as uh, some of their projections, and then maybe you can discuss a little bit more what we think the going forward looks like. So let's see here. So that's what the press release looked like, right? So nothing really earth-shattering, right, Sean, compared to what we have seen before. It's still the same messaging that they want to focus on the 2% as well as uh, uh, the labor activity. That these two items are really their core focus, and uh, I think that is when we look back over the last year or so since they started the aggressive raising, that has been always the theme. So nothing new here. And as a result, as many of you already know by now, is they kept the rate as is. But they also have mentioned that they may raise the rate in July and forward by another 50 basis points until they believe they may have reached, as they call it, the terminal rate or the peak, whatever you want to call it. Uh, Now, I think one interesting statement certainly is that they would be prepared to adjust the stance of monetary policy as appropriate risk emerge that could impede the attainment of the committee's goal. So I think it still leaves them a little bit of a way out of raising another 25 or 50 basis points if something else is suddenly showing up over the next few weeks. So we will see how that all works out. During his press conference, there again, Chairman Powell clearly talked about how strongly committed they are to bring the inflation to the 2% goal. And once again, as in every previous press conference, he highlighted the fact that without price stability, we will not achieve a sustained period of strong labor market conditions that will benefit all. Right. So this is ongoing theme, and I think that's why anyone who believes that we will see a significant rate reduction going forward until they believe they have achieved these two goals here, we likely will not see a drastic reduction in the rate. Uh, so obviously they decided to leave the policy interest rate unchanged. At the same time, they continue to reduce their securities holdings, so the tightening continues, right? So even though the rate stays the same, so only the tightening in the credit market will continue as we already have seen it. Uh, and then again, nearly all committee participants view it as likely that some further rate increases will be appropriate this year, right? So this is a pretty strong statement. So naturally, the question is, why is it that uh, they uh, they raised it, uh, but they kept it as is rather than raising it now and then let it be going forward, right? So it's a little bit of a questionable approach to it. Some people felt, well, it would have been better to raise another quarter point or whatever it might be, and then reaching that terminal rate and then see how it turns out, and potentially also lowering the rate from there. So what's your take on that, John?
Yeah, and Ton, I think like you mentioned initially, like nothing's really changing too much in the language. It's still the primary drivers. I think I'm surprised that personally that the labor market remains as tight as it has been, at least the numbers that they're looking at. And I want to say that, as I recall, the Q&A section from the meeting on Wednesday, everyone, the multiple questions trying to pin down, like, what's your turning point? And they're very, relatively left themselves the latitude of like, well, we look at a multitude of things was generally the answer. Um, you know, I, yeah, I don't know that it's in any way on the radar on their dashboard, but I would note that, with this pause and, maybe part of it is still trying to give some relief to the insured banking system, to our regional banks and smaller community banks. I think I was looking at a article a little earlier this week that there's just a continued upward trend in the use of the facility to provide liquidity to these institutions, even though we're now months away from the onset of those banking crises. So maybe that's part of it. To your point, why do we not see another bump up if we clearly have most of the members looking and expecting to see additional increases? Maybe they just need to have an additional period of quiet during the summer to allow some of these institutions to quietly shore up their balance sheet. I believe that facility is up to a year, and if as we continue to see rates tick up even just marginally, it maintains the effect that those instruments are underwater and that they're being lent face value on these underwater instruments. So my gut feel is that that's something in the background. Otherwise, I don't think I gleaned any insights other than that, that it continues to be, there are factors in the market that continue to press upward, and they're watching it. Like there's not a all clear that we've gotten enough of the air out of the balloon just yet.
Yeah, it's a good point. Right, obviously, you mentioned right. Their view is that the banking system is very sound.
It's
Uh,
always sound until it's not.
I'm not so sure that that is a true assessment of what is really happening in the in the trenches, but it's all relative, right? So, what is the definition of sound? Or if no bank run is happening, obviously banks are liquid, right? If nothing drastically happens in the marketplace, all banks are solvent, but all that can change very quickly. So that's why it's all relative, right? So no one thought that SVB would get into that situation that quickly, right? It was really a liquidity crisis that potentially was temporary, that then with that bank run turned into a solvency crisis. And same thing happened to Signature Bank and some of the others. So
Yep.
that is the core element really of banking, right? You have that mismatch of maturities, deposits, and what you have in your investments. And once you have that run, any bank ultimately can become illiquid and ultimately insolvent, even the biggest, right? So
And,
it's
yeah,
all based on trust at the end of the day. So is that statement correct that the banking system is sound? Right now, it's only if nothing else happens, the answer is yes. But it's only a very fragile situation we are in, and that could very well be the reason why they didn't raise the rate, as you mentioned earlier, right?
yeah. One other thing that like stuck out in my to just small note was, and can't recall if this was part of the prepared remarks or not, but Some of the comments that we've been seeing consistently is this trying to get in front of the cementing of inflationary expectations. And I want to say that I heard Powell say basically that is now an expectation that is basically baked in some degree of it. So, I think that kind of points to the perspective, if they're surveying and they're seeing the feedback that everyone, either at business investment on the consumer level, the financial markets, have baked in still further inflationary pressures on different types of either consumer or business goods, or the labor market being so tight. I'd imagine that they'd have to have some peak of sunlight there, some change before they would feel comfortable feeling that they could just come to a complete stop. So anyway, that's just one little comment that stuck out, was that it sounded like the wording, and maybe it was in a Q&A, but that they didn't sound like they're trying to stop these things, but that they are now in place, and so that they're resolved to have to try to stamp that out, so to speak. Obviously seems to be firm, and they're committed to it.
Yeah. Okay, very good. So they also released their summary of economic projections, as they do on a regular basis, right? So that is always interesting to see what their thoughts are of various economic indicators. Now, when we look at some of them, obviously the key pieces are the GDP, and when we look at that number, I would say initially it was more at the when we look earlier in the year, it was a much slower growth that the forecast. Now they upped that from 0.4 to 1.0. So that certainly is an interesting element, where they felt the market is actually much stronger than what we originally anticipated. Now the unemployment rate, they actually also bring it down to 4.1, where they initially had it at 4.5. Next year, there is not such a big difference, and the following year, it's not that much. But it's only for this year. It clearly shows that they feel that the economy has more strength than they anticipated. And I think that's also an element why they still talk about raising in order up to 50 basis points later this year. Inflation-wise, I think we are more or less in the same ballpark, except the core inflation, where they also upped it a little bit for this year. Right. Now, when it comes to the Fed fund rate, that is, I would say, is a pretty interesting aspect there, where in March, when they had the last projections published, they anticipated to stay just slightly above the 5.1, and this time around, the consensus is, as the medium, at 5.6, right? And that's where that additional 50 basis points really comes in. I would say in March, they probably thought by now we are done with the race. Now the view is based on the stronger growth, also a little bit more pressure on the inflation side. They just do not like to be still, as we are right now, in the 4.5% range. They hope that we will come in a little bit lower, that they've entered that up. Obviously, that means also 2024, the median might be still in the roughly in the 4.5 range. And even in 2025, we are still well above of where we would be in the long run as a target, right? So that's projections. I would say any one of you who wants to have a little bit more of insight there, please go onto their website and look at their various charts and information that they have published. It's very, very interesting. Now, let's have a quick look at what the markets think about all this, right? So the Fed, this is the Fed dot plot, and the blue dot here is the median of what the Fed is projecting over the next few years. Now, it's interesting to see that certainly for starting early next year, when the Fed rate median clearly is above where SOFR forward expectations are, right? This is the one-term SOFR, that's the forward curve, right? And while the market only anticipates with additional increase, maybe by a quarter point later this year, they do not believe that we go all the way up to with the 50 basis points, and that we are actually see the first reduction sometime later this year. So there is clearly a difference between what the Fed views the market and how the market as a whole looks at it when we look at the 1 month term SOFR rate, which is the key borrowing rate for all short-term loans for a majority of short-term commercial borrowings. And that trend really continues all the way out, all the way until we are in 2027, where the general view is that the Fed right now is a little bit too conservative when it comes to keeping the rate high. Obviously, we do not know who is right. This is strictly just a representation of what the market thinks compared to what the Fed thinks, right? Time will tell who is right, right? Now, I think a couple of key elements that we need to think of here, right? SOFR was in 2021 until early 2022 was down at virtually zero, right? 0.05 to 0.1%. So as a commercial real estate borrower with also very aggressive bridge loans and construction loans and other short-term loans, many could borrow just around the 3% mark to 3.5% mark, right? So let's assume that it was a spread in average of 3.5%. You could borrow roughly at 3.5%. Even based on the forward, the market thinks by October, or let's say by June of 2024, the market anticipates SOFR to be around 4.3%. So now add to that the typical spread in the marketplace of 3 to 3.5%. So we are still at 7.5, roughly, to close to 8% in a all-in rate, which is still essentially more than double of where we started out with many of these loans in 2021 and early 2022. So anyone who thinks, well, next year will be better, yes, SOFR may come down by 75 basis points, maybe even by a full point, but the actual borrowing cost will still be significantly higher than where we started out 2 years ago. And that also has an impact on interest rate cap renewals. So all you borrower out there who hope for that significant drop in SOFR, even if it drops by 1%, you are not out of the woods there, right? And even when we look out further out into all the way end of 2025, we are still, based on market forecasting, around 3%. So that still translates to 6.5% to maybe a little bit more in an all-in rate. So still double of where you started out in 2021. So keep that in mind, right? When you say, well, the rates are coming down, so that will be a rescue. Not really. If SOFR comes down significantly more, you can be guaranteed that we have a distressed environment and it's very hard to borrow. So if you can borrow, the credit spreads will be significantly higher. So whatever it is, you have to anticipate that your borrowing cost continues to be at least double of where you started out in 2021. Do you have any comments on to that, John? In addition,
Yeah, well, I would just ask this question, Anton. Like, as you've worked with different groups that maybe in the syndication space that have had to, go back out for additional capital calls, I imagine that they've been putting out their thesis as to where they believe they would be in this, year forward, year and a half forward, this timeline you're highlighting right here. Have you seen those expectations reconcile that 6.5%+ reality? That seems, at least now, what's being maybe anticipated, or are folks just still a little bit of hope and prayer and being aggressive as far as where they think they'll be in that, year and a half, 2 years out?
hey, glad that you asked, John. So that brings us to, right, so here we talk about SOFR, right, which is the short-term borrowing. That's typically what everyone borrowed, particularly in the syndication space in 2021 and early 2022. And everyone anticipated that within 2 to 3 years, they would refinance into a permanent loan. What is the index rate on that permanent loan that they would look at? It's a 10-year treasury, right? Mm. So now when we look at the 10-year treasury, a forward curve, right, we were obviously at record lows in 2021 with the 10-year treasury too. So we had all-in borrowing cost that was for, let's say, a larger multifamily property, just around the 3% mark for a 10-year fixed, right? So right now we are roughly at 3.7, close to 3.8 today, the 10-year treasury yield. So we are obviously significantly higher than where we were back then. So back then, many anticipated that the exit refinancing out of these bridge loans or construction loans, or if a new buyer will come in and buy their stabilized property, that the all-in fixed rate will be just around 4%, right? So now the reality that we are facing today for a larger loan again, right? So we talk about 3.7%. If you get some affordability discounts and so on, you need to add a spread of at least 1.7, right? So now we are at, let's assume it's at the 3.7% as a 10-year treasury. You add 1.7, so you're at the 5.4% rate, right? Yeah. That is roughly 1.4% above of where many forecasted the refinancing would take place. And that also had a positive impact into loan proceeds because the debt yield and or debt service coverage ratio that was projected into year 3 of these deals was supporting that loan amount. So there again, right, so many thought, well, rates will come down. And yes, SOFR may come down significantly. But the reality is that we have, even if SOFR comes down by, let's say, 1%, as you know, right, we have a very a significantly inverted yield curve that eventually will go get back to normal. So what does that mean? The market thinks that the curve will get back to a normal upward curve sometime in early 2025, right? What does that mean? the 10-year treasury will not come down significantly if it comes down at all. So the market, when we look at here, really the lowest level the market thinks the 10-year treasury is going to go is at just slightly above 3.5%, which is not really that much above the 3.7538 we are today. And in other words, we will likely still be at an all-in rate that is at around 5.2, 5.3% plus, right? Still very significantly higher than what everyone was projecting within their underwriting, including lenders. And as a result, the challenge is that very often the NOIs that someone has projected and the loan proceeds that they anticipated that they will get with that cannot be achieved. That means that more likely than not, even if everyone achieved all the NOI projections, more likely than not, they would still have to bring some equity to the table in order to refinance out of that bridge or construction loan. Right.
Yeah.
So that's the reality, really. Right?
Yeah, and not to draw out your point, but your comment, like even if you hit your projection, and I know that we continue to see headwinds, either pick your local CAD district, appraised assessed values still being increased year over year significantly, and then a significant number of markets. And then on top of that, costs like insurance just aren't leveling out in the year over year increases. So it's a significant amount of headwinds, and hopefully we don't have a softening that makes it even tougher on rents.
Yes, obviously you bring up another point, which is rent growth has been slowly coming down significantly. The Fed, also Chairman Powell, has indicated in his Q&A session, right, that they're concerned about the rental market. So because it has obviously an impact on inflation, and as long as rents are growing above that 2% mark, I foresee that they're also watching that. So it's if you can get the strong rate growth, expect higher interest rates. If rent growth drops, maybe then they will also pivot in lowering the rates, but then you also have an issue ultimately with your NOI. That's on the rental income side. We are not even talking about higher delinquencies. And obviously, we are not talking about higher operating expenses everyone is struggling with, whether it's insurance, property taxes, payroll, and virtually every other line item, right? So there's only plenty of headwinds there. That's the reason why I think there will be certainly quite a bit of opportunities in various asset classes. It's not everyone talks about multifamily, but I think there will also be some others where there are some opportunities, particularly where deals were bought with bridge loans at that point. And we will see how where the chips fall. But I think the message with this year, obviously, as a listener, either you believe in this chart or you don't, right? This is what the market believes. You may believe in something else, so that's more power to you. But I think it's still important to understand what the market believes. And what is also important to consider is that the market is actually much more aggressive when it comes to what they think the rate, how much faster the rates will come down than what the Fed thinks. Remember, the Fed is still well above the market by January of 2025, and it's also much higher by the end of this year. So it will be very interesting to see who is actually right here. Right.
Yep. We'll meet up again soon, right? Take another
That's
swipe
exactly
at this.
right. Yes. So, do you have any final comments, John?
No, I mean, I think we continue to encourage investors. If you've got something coming up in the next 12, 18 months, reach out, let us size it up, get a feel for what's available now, get your plan together. And, maybe you have a difference of opinion about what those curves will look like. Great. But, it's a relatively modest amount of effort to get an understanding of what you're facing now. And, you can plan from there versus, putting it out and hoping that you're going to see something change. I just don't feel like that's going to come our way. I don't know that it's going to get worse necessarily than these current expectations, but it's a lot to work with. There's a lot going on. I could understand investors, feeling a little bit overwhelmed and not wanting to see the numbers, but you have to know what you're looking at.
Yes, absolutely. Right. So what I encourage you, reach out to your trusted debt broker, whether it's us or anyone else, right, who can discuss with you how the likely refinancing scenario looks like, or even if you plan to sell, what the likely financing would look like for the new buyer. It's important to have that estimate in place so that you can figure out whether you have enough reserves, whether you need to raise reserves, whether you potentially have to do a capital call because you may not be able to get out of the in-place loan without a capital call. Whatever it might be, it's better to know now what the likely scenario looks like rather than just sticking the head in the sand and hope that rates will drop. Yes, rates may come down, but it's not nearly significant enough that if you're in trouble, that will rescue you. And so we really encourage you to start taking action now for anything that comes to over the next 18 months to 24 months. That time comes around very quickly. Also, if you have a deal that you think is okay, revalidate that it's really okay, right? Don't just think it is or hope for the best, and also still continue to make distributions when in reality you may run out of money at some point, right? So please feel free to reach out to us at info@peakfinancing.com. Also, put a comment in the comment boxes if you agree or disagree with what the Fed forecast looks like and with what the market thinks the forecast looks like. Obviously, everyone has their own crystal ball, and only the future will tell us where we ultimately are going to be. But it's only a very, very interesting environment we are in. And I would say everyone needs to buckle up for a wild ride over the next 18 to 24 months. A lot of people will have a pretty difficult time, and it's better to be prepared than to be sorry, right? So thanks again, John, for joining me.
Thanks, Tom.
Let's talk soon. Bye, everyone.
Take care.